Hello and welcome to Module 1 of the Options Trading Masterclass, Options Trading. In the first part of the Options Trading module, we will explain what an option is and the important components and terminology of an options contract that you must be familiar with before trading options. In this lesson, you will learn what are options or options contracts, how option contracts work, the different types of options available to retail traders, and the terminology associated with options. Options are one of the most feared words in the investment industry, with many traders and investors terrified of the risks and the danger of large losses associated with them. The truth is that any leverage product can carry significant risk and danger, especially when they are used by investors who don't understand them. When used correctly, options are amongst the safest financial trading instruments available to traders and investors alike, as they are one of the few instruments that can provide a certain dollar outcome regardless of the market behavior. So what are options? Options contracts are used for many different purposes, ranging from the purchase of land and buildings to manufacturing supplies and infrastructure. Options contracts can come in many different styles and forms, but this course will focus only on exchange-traded options, also known as ETOs. An ETO is a standardized derivative contract, and as the name suggests, these contracts are traded on an exchange such as the ASX in Australia and the CBOE in the USA. ETOs are settled through a clearinghouse, which enables them to be guaranteed. Now, an options contract represents a set quantity of a specific financial product. Generally, an options contract on the ASX exchange represents 100 units of the underlying share. As an example, one option contract of CBA, the Commonwealth Bank, represents 100 shares of the company. There are some instances where individual companies have a number different to 100 due to special conditions or share placements, so ensure you always check the correct number of units with your broker prior to placing a trade. It is important to note that options contracts on assets and other financial instruments, such as indices and commodities, can represent a different number of underlying units. Now let's have a look at how options work. Now, in its most simple form, an option is a contract which allows the option buyer the right, but not the obligation to buy or sell an asset at a predetermined price in a specific time frame. There are always at least two parties in an options contract transaction: an options buyer, also known as an options holder, and an options seller, also referred to as an options writer. To help explain this, let's use an example that isn't related to the finance markets, as it will clearly illustrate how an option contract works. This example is a direct representation of how an ETO would work in the financial markets in terms of transactions and process. Terry, the options buyer, wants to purchase a racehorse from Barbara, the options seller, for $10,000, but needs to save up and pay for the horse first. The horse is due to have its first start in a few days, and if it performs well, could be worth more than the current value of $10,000. Conversely, if it performs poorly, its value could drop and be worth less than $10,000. Now, Terry really likes the horse and isn't willing to take the chance that he may have to pay more for the horse in the future if it performs well. Terry asks Barbara not to sell the horse to anyone else for 90 days, allowing him the time to save enough money. Terry offers to pay Barbara $300 to sell the horse to him in 90 days for the agreed amount of $10,000. Now, if Terry can find the money to pay for the horse in 90 days and still wants to buy him, he will pay Barbara $10,300. $10,000 for the horse and $300 for holding the horse for 90 days. Now, if Terry can't find the money or changes his mind about buying the horse, he can walk away with no further obligation or cost other than the $300 he paid to Barbara for the option to purchase the horse in 90 days. Terry and Barbara have effectively entered into an options contract with a 90-day expiry date at a strike price of $10,000. So why would Terry pay $300 to Barbara to lock in a fixed price? From Terry's perspective, he is giving himself the opportunity to own a racehorse for a fixed amount, $10,000, with all the upside potential. If the racehorse were to win or perform exceptionally well over the next 90 days, without a fixed price contract in place, Terry may have to pay a lot more for the horse than the current value. Now, just as importantly, Terry could walk away from the transaction if the horse doesn't perform as expected. There are many things that could go wrong with a racehorse in 90 days. It could get sick, injured, or may perform badly at the races. Terry has effectively removed the risk out of the transaction and given himself a chance to evaluate if the horse is still worth $10,000 after 90 days. The opportunity to buy the racehorse for the current value of $10,000 in 90 days has come at a cost of $300. It is important to note that for the purpose of this example and the future examples in this module, we will not include brokerage costs to simplify the explanations. The brokerage costs associated with options trading will be explained later in the module. Now let's look at options in the financial markets. Options in financial markets are a contract that enables an investor to buy or sell a specific financial product that the option is intrinsically linked to. Options are known as derivatives because their price is derived from another financial asset. As an example, if you have an option contract on CBA, the price of that option will fluctuate in line with the rise and the fall of the CBA share price. It is important to understand that just like in the previous racehorse example, the buyer of an option has a right, but not the obligation to buy the underlying asset at an agreed price prior to a specified date. As an example, if a trader was to buy a CBA options contract at a strike price of $80 with an expiry date of the 26th of June 2020, they have until the close of trade on the 26th of June to exercise the option contract and purchase the specified number of shares at the agreed price. Now, strike price, expiry date, and exercise are all terms that we will be explaining shortly, but for the purpose of this example, they are used to essentially highlight how an options contract works. Now let's have a look at the different types of options. Despite the broad range of option strategies you may have heard of or are familiar with, there are only two types of options: a call option and a put option. Once again, there will be terminology used in this section that you may not be familiar with, such as expiry dates and strike prices, but these will be explained in detail in the next section. Let's first look at call options. Call options in the finance markets are best described as a financial contract that gives the call option buyer the right, but not the obligation to buy a financial asset at an agreed price within a specified period of time. The financial asset is called the underlying asset, and the call buyer profits when the underlying asset increases in value. As we mentioned earlier, there are at least two parties involved in every options transaction: the options buyer and the options seller. As an example, buying a single call option contract on CBA, representing 100 CBA shares, will give the call option buyer the opportunity to gain from a positive move in CBA above $80, which is the strike price, after the close of trade on the 26th of June 2020, which is the expiry date. Now, from the call option seller perspective, selling a single call option contract on CBA will give the call option seller the obligation to provide the options buyer 100 shares of CBA at the close of trade on the 26th of June 2020 at the price of $80. Now let's have a look at put options. Put options in the finance markets are best described as financial contracts that give the put option buyer the right, but not the obligation, to sell a financial asset at an agreed price within a specified time period. The financial asset is again called the underlying asset, and the put buyer profits when the underlying asset decreases in value. As an example, buying a single put option contract on CBA, again representing 100 shares, will give the put option buyer the opportunity to gain from a negative move in CBA below $80, which is the strike price, after the close of trade on the 26th of June 2020, the expiry date. Now, from the put option seller perspective, selling a single put option contract on CBA will give the put option seller the obligation to purchase 100 CBA shares at the close of trade on the 26th of June 2020 at a price of $80, the strike price, from the put option buyer. Now, this is a very basic explanation of what a call option and a put option is, so don't worry if you are having trouble working out why each of these parties would enter into this agreement, as we will explain the benefits of each side of the transaction later in the module. Now let's take a look at American and European style options. There are two main styles of options that you'll be exposed to in the finance markets: European options and American options. Now, the important thing that you need to be aware of between these option styles is how the expiration methods differ from each other. Both have an expiration date built into the option contract, but the difference lies in how they can be exercised. An American option can be exercised by the option buyer at any time up until the expiration date. This means that if the option buyer held a 90-day call or put option on CBA, which had an expiry date of the 26th of June 2020, they can effectively exercise that option at any date between when they first purchased the option right up until the close of the 26th of June 2020. On the other hand, a European option can only be exercised on the expiry date. This means that if the option buyer held a 90-day call or put option on CBA, which had an expiry date of the 26th of June 2020, they can only exercise that option at the close of trade on the 26th of June 2020. Now, there are a few different reasons why one option style may be more suitable than the other at different times, but for the remainder of the options trading masterclass, all the strategies discussed will be based on European options. The majority of the strategies we will be demonstrating involve multiple option combinations, which are required to expire at the same time to be effective. Although it is possible to use American-style options as substitutes, it adds a layer of complexity because of the possible early exercise events, and as such, these should only be used by very advanced traders. It is also very important to remember that all of the option strategies in the options trading masterclass will be expected to either expire worthless or be closed out early. Unless it is specified for a particular strategy, you should never allow an option to be assigned, as they should be closed out before expiry if this is a possibility. Now let's look at options terminology. The options terms we used earlier to describe an options contract are universal, and we will now break each of the terms down to give you an understanding of what each term means and how it relates to an options contract. To help explain these terms, we will use the data from the CBA example we used earlier for both the call and put options. Let's start with the strike price. This is the agreed price that is unique to the options contract. In the CBA example, the strike price is $80. This is the price the option seller has agreed to sell the CBA shares to the option buyer. Expiration and expiry dates. Every options contract has an expiry, and this is the date at which, once passed, an option can no longer be exercised. In the CBA example, the expiry date is June 26, 2020. It is important to note that in Australia, the expiry date refers to the close of trading on the expiry date for shares. However, for indices, the first tick on the expiry date confirms the price that will be used to close off the options contract. The exercise price. This occurs when the option owner takes up their right in the option contract. The owner of the CBA option buys or sells their allotment of CBA shares at $80, which is the strike price, and the option seller is required to take the other side of that trade. Remember that for every option buyer there must be an option seller, so each option contract will always involve a transaction with at least two parties. As a side note, the reason why there can be more than two parties in a transaction is purely because the transaction is facilitated by a regulated exchange. The buyer of a call will never know the identity of the call seller and vice versa. As an example, if a call buyer wants 10 contracts of an option, one call seller may not have enough contracts on offer. In these instances, the exchange can still facilitate the trade, but it will use the same option contract for multiple call sellers to fulfill the order. In the example that we can see on the screen, there may be a call seller wanting to sell 3 contracts and another wanting to sell 7 of the same contracts that the call buyer is requesting. This means that there are enough contracts on offer for the call buyer, and the trade will be executed by the exchange. Assignment. When an option buyer exercises an option seller is assigned and must fulfill their obligation. As an example, if the CBA share is trading at $90 at the expiry date, the option seller is obligated to sell the allocated CBA shares at $80 to the option buyer. In the money. For call options, this means the share price is above the strike price. This means that if the CBA share price is trading at $90, because the strike price is $80, the option is $10 in the money. In the case of put options, it means that the share price is below the strike price. As an example, if CBA is trading at $70, because the strike price is $80, the option is $10 in the money. Out of the money. For call options, this means the share price is below the strike price. This means that if the CBA share price is trading at $70, because the strike price is $80, the option is out of the money. In the case of put options, this means that the share price is above the strike price. Using the previous example, this means that if CBA share price is trading at $90, because the strike price is $80, the option is out of the money. At the money. For both call and put options, this means the share price is equal to the strike price. It is important to remember that the strike price and the share price will very rarely be exactly equal, and even when they are, it does not remain so for long, due to market fluctuations. As such, when purchasing options, the strike price closest to the share price is generally referred to as at the money. As an example, if the CBA share price is trading at $79.90, it would be considered at the money with the strike price at $80. Intrinsic value. The amount an option is in the money. It is important to remember that only options that are in the money will have intrinsic value. As an example, for the call option, if the CBA share price is trading at $90, because the strike price is $80, the call option has an intrinsic value of $10. In the case of a put option, if the CBA share price is trading at $70, because the strike price is $80, the put option has an intrinsic value of $10. The option's premium is the price of the option. This is effectively the price paid for the rights that the call or put option provides the call buyer, and this is paid to the option seller. Time value. This part of an option price is based on its time to expiration. When the amount of intrinsic value is subtracted from the option's price, the option's premium, only time value remains. If an option has no intrinsic value, as is the case for options that are out of the money, its entire value is effectively time value. This section was designed to provide you with an overview of what options are and how they work, but this information will form the structure for the remainder of the options module. If there is any part of this section you don't completely understand, it is very important that you review it again prior to progressing to the next section to ensure that you don't have difficulties for the remainder of the options module. In this session, we have learned what options or option contracts are. We explored how an options contract works for both buyers and sellers. We took a look at the different types of options available to retail traders. And finally, we explained the different terminology associated with options. In the next section, we will take a closer look at call options, breaking down why buying and selling call options can be so powerful when used in the correct market environments.